Hi, welcome to this video where I'm going to look very quickly at the treatment of goodwill following a merger or an acquisition. Okay, goodwill is covered by IAS 38, which is intangible assets, and the International Accounting Standard doesn't just look at goodwill, but it also looks at other things like purchasing patents, brand names, etc. There are three key things that goodwill needs to be identified as having. First of all, it must be identifiable. So what is it that we've purchased that has a value? Although the goodwill itself is a intangible term, are we buying the right to brand names? Are we buying the right to particular locations? What is it that that goodwill actually equates to? And normally it will also be related to the fact that you can make higher profit than normal for the assets that are being used by the existing business. It's got to be something that is controlled by the business. So buying a company, for example, that has a franchise, there you are not buying a brand name, you are buying a right to use that brand name. So that wouldn't be controlled by the business. And it's got to be something that will derive future economic benefits. So what we mean by that is it's whatever it is that we are buying is going to generate more profit than if we were to just go out and purchase the assets and use the assets in a normal business situation. So I've said it also applies to other things like patents. Normally, intangible assets only arise from purchase by a business. There is some guidance and there is some possibility of putting some research generated goodwill into a business, but they are very, very strict and only occur at quite a late point in the development process. So for the purposes of A-level economics, just assume it isn't something that's going to happen. The intangible assets that we are concerned with are the ones generated by the purchase of a business. And the business needs to think about two things when it puts a value on it. The first thing is the fair value of the business they are buying, which is the assets of the business take away the liabilities. And the goodwill then is considered to be the difference between the purchase price of the business and the fair value. And that's so that any goodwill generated at least follows a money measurement concept. So we are saying, for example, if the assets of a business are worth 1 million, the liabilities are worth 500,000, and the business was purchased for 700,000. Well, I could purchase the asset part of the business, if you like, for 500,000 because that's the difference between the assets and the liabilities. But the overall purchase price is £200,000 bigger, and that element would be considered to be the goodwill. And that does exist because the business acquiring the business, so the purchaser has agreed to pay 200,000 extra over and above the net asset value. Okay, the next stage is the business needs to decide if the intangible asset either has an indefinite life or a finite life. And that's important when we come to looking at how we would depreciate it. The normal term for depreciation when we talk about goodwill is actually amortization. So we wouldn't say that we depreciate an intangible asset, we would say that we amortize it. Okay, business has got a number of options that it can follow when it looks at the goodwill. They have got an option to write off the value at the date of purchase. That's not a common way for it to happen because if they write off the value, that is creating a large loss for the business straight away on acquisition. And that would deplete their revenue reserves and their ability to reward their shareholders with dividends. If the goodwill is determined to have an indefinite life, then what they should still do is review the value of that goodwill at least once a year. And being realistic, businesses will only do it once a year. And that is to ensure that they are still generating the revenue and the profits they assumed when they purchased the goodwill. So even if you were able to go down that route, you would still need to check that, for example, when Kraft purchased the Cadbury's brand, that it was still generating the level of profits and the level of revenue over and above what they would normally have expected for those assets into the future. And if they don't, then you need to reduce down the value of the goodwill. The bit that's more relevant to an A-level answer, though, the finite lifetime. And if it has a finite life, then the assets, the goodwill that you've purchased, should be written off over the life, normally using the straight line method. So if you bought goodwill for £1 million and you thought that that goodwill would last for 10 years, then the amortization value in the account should be £100,000 every year. And that would write down the value to zero at the end of the 10-year lifetime. And it does also state that businesses should continue to review the value of that goodwill to make sure that it shouldn't be depreciated or amortized even quicker. Now, the idea and the justification for writing down the goodwill over the life of the business is that it does clearly follow the matching concept. So as we use up the goodwill that we purchased, for example, by buying a patent, the value of the goodwill used up each year of the remaining years on the patent would be created as an expense, and that would be matched with the revenues in that particular year. And what it also does is it could be confusing to an investor if we wrote off a large parcel of goodwill in 1 year. That would lead to a large fall in profits. And although it would go in as an exceptional item, that might confuse investors and might lead to them making bad decisions, because what they don't realise is there would be a significant increase in the profit in future years as that goodwill wasn't being written off. Now, there are some problems with this approach and with valuing goodwill in an accounts full stop. The first one is just a practical one. So companies normally consider goodwill to have an infinite life, and they do that, as we've discussed, to try and not have that large decline in profit in the year when they write it off. How good companies are at actually then checking the value of that goodwill into the future is a bit open to question. So, for example, in 2018, Kraft, I've already spoken about as a purchasers of Cadbury's, they were forced to write down a lot of their intangible assets as a large one-off hit, because when there was an external review conducted, it was determined that a lot of these purchased intangible assets were not generating anywhere near the profits that were anticipated when they were purchased. So how well companies actually review their intangible assets is very, very questionable, and it could be argued that they are not reviewing them so as not to reduce profits. But that will have a long-term impact on the business. So obviously writing down the goodwill then creates a large loss, and that reduces capital reserves and the ability to pay dividends into the future. And an argument against doing it is also the prudence concept, because although we've said that companies should be reviewing the value of their intangible assets on a regular basis, this isn't as easy said as done. How do you put a value on owning a brand name, even a famous brand name like Cadbury? We've got an historic price that that goodwill was worth because Kraft purchased Cadbury's and did pay a significant premium over the net assets. But who was to say they could get that same premium today if they were to sell the brand. And in terms of an A-level answer, I think really there are arguments for writing off goodwill in a year and for amortizing it. And the question that you need to decide in your own mind, perhaps looking at the information in the question, is which of the two options most meets the true and fair question that should be asked of any accounts. Okay, thank you very much for listening. My students obviously email me if you've got any questions, and I look forward to seeing some of your answers to questions on Goodwill. Thank you very much. Bye-bye.